47.6 million ounces vanished from COMEX vaults in 4 trading days. December 2025. More than 60% of registered silver gone. Oh, that's not profit taking, that's a bank run. And here's what terrifies futures traders. The March 2026 contract represents 500 million ounces of silver promises, but there's only 124 million ounces registered for delivery. When the math breaks this badly, markets don't adjust, they explode. I'm about to show you the 4-stage pattern that destroys every paper market in history. Silver just entered stage 3, and when stage 4 hits, there won't be a paper price anymore, only physical. The people holding promises will learn the difference between owning something and owning a claim to something. That difference is about to cost them everything. But first, let me prove this pattern with the most brutal example in market history. 2 brothers, 200 million ounces, and a plan that almost broke the entire financial system. January 1979, Nelson and William Hunt start buying silver. Not trading it, taking delivery, physical metal, real silver. They accumulate 200 million ounces, half physical, half futures contracts demanding delivery. Their thesis? Nixon killed the gold standard in 1971. The dollar is dying. Silver is real money. They weren't wrong. January 1979, silver trades at $6. September, $10. December, $30. January 17th, 1980, $49.45. That's 724% in 12 months. The Hunt brothers are worth billions. They're the richest men in America. And Wall Street is terrified. Not because of the price, because of the delivery demands. The Hunts aren't speculating. They're draining physical supply. Every futures contract they own represents real metal they plan to take home. And COMEX is running out. Sound familiar? Because here's what happened next. COMEX panics. The vaults are emptying. If the Hunts keep demanding delivery, the exchange fails. So COMEX does what exchanges always do when they're losing. They change the rules. January 7th, 1980. Silver Rule 7. No more long positions. You can sell, you can maintain existing positions, you cannot buy. Translation: we're freezing out anyone trying to squeeze us, but silver keeps climbing anyway. Until January 21st, margin requirements get raised drastically. Overnight, holding futures becomes impossibly expensive. The Hunts need hundreds of millions in additional margin. They scramble, they sell, others panic and sell. March 27th, 1980, Silver Thursday. Silver collapses from $21 to $10. $80 billion of market value, gone in one day. The Hunt brothers lose $1.7 billion. They declare bankruptcy. Brokerage houses teeter on collapse. Banks freeze credit for 48 hours. The system almost breaks completely. But here's what everyone forgets. The people holding physical silver didn't lose anything. When the dust settled, silver was $10. That's still 66% higher than where it started. Physical holders made massive returns. The Hunt brothers failed because they used leverage and paper contracts. The system changed the rules on paper, but you can't change the rules on metal you actually own. That lesson matters because we're watching the exact same setup today, except this time it's worse, much worse. The COMEX registered inventory that broke the Hunt brothers? 200 million ounces. Today's COMEX registered silver, 124 million ounces, less than half what existed in 1980. But annual industrial demand? 700 million ounces, up from 400 million in 1980. The math is insane. 124 million ounces of deliverable silver, 500 million ounces promised in the March contract alone. That's a 4-to-1 paper-to-physical ratio in a single month. Add up all the contracts, ETFs, and derivatives, and some analysts estimate 356 ounces of paper claims for every ounce of physical silver. Remember, in 1980, COMEX had more silver and less demand. The Hunt brothers still almost broke the system. Today, COMEX has half the silver and double the demand. Industrial users who need silver for solar panels, electric vehicles, 5G infrastructure, they're not speculators. They can't take cash settlement. They need actual metal, and they're panic buying. December's delivery demands wiped out 60% of registered silver in 4 days. Not 4 months, 4 days. JP Morgan alone reportedly moved 13.4 million ounces from registered to eligible, removing it from delivery availability right when demand peaked. That's not coincidence, that's survival. Here's what makes this different from 1980. The Hunt brothers were 2 billionaires fighting the system. Today, it's the entire world fighting a shrinking supply. China restricted silver exports January 1st, 2026. Shanghai silver now trades $10 above London prices, the biggest geographical premium in precious metals history. India's silver imports hit records. Central banks are accumulating silver as a strategic asset for the first time in 70 years. Industrial demand isn't speculation. Solar panels consume 120 million ounces annually. Electric vehicles use triple the silver of gas cars. AI data centers need silver for conductivity. 5G infrastructure devours silver for connections. This demand is mandated by law across Europe, China, and the United States. Policy doesn't care about silver prices. The green transition continues regardless. Supply can't respond. 70% of silver comes as a byproduct of zinc, lead, and copper mining. Higher silver prices don't create more silver if base metal economics don't justify mining operations. Primary silver mines represent only 25 to 28% of global output, and those mines take 7 to 10 years to develop. We don't have 7 years. The deficit is structural and accelerating. 2024 saw a 148.9 million ounce deficit. 2025 projected at 117.6 million ounces short. That's 5 consecutive years of consuming more than we mine. Where's the difference coming from? Above ground stocks, vaults, exchanges, ETF inventories, they're being drained. London Metal Exchange, silver stocks collapsed to historic lows. LBMA, the London Bullion Market Association, vaults lost 40% of holdings since 2020. Shanghai inventories hit decade lows, and the paper market is breaking. Silver lease rates spiked to 200% annualized during periods of tightness. That means people pay 200% interest just to borrow silver for a year. That's desperation. Backwardation appeared, spot silver trading above futures prices. That signals immediate supply panic. People pay premiums for silver today rather than accept promises of silver tomorrow. COMEX's last stand is coming. When registered silver drops below 50 million ounces, the system faces crisis. At current drain rates, 60% gone in 4 days, we're talking weeks, not months. When it happens, trading halts become common. Delivery failures cascade. Contracts get cash settled against buyer's will. Premiums explode. Physical dealers charge $50, $60, $70 over spot just to get metal. Then one day, the paper market freezes entirely. Contracts suspended, lawsuits filed, regulators investigate, and people holding physical silver watch from safety because they already won. This isn't speculation. This is pattern recognition. And every indicator is flashing red. The Hunt brothers were 40 years early, but they were right about the fundamentals. Industrial demand, monetary debasement, finite supply. The setup that destroyed them is back. Except now, instead of fighting the system, the smart money learned from their mistakes. They're not using leverage. They're not making noise. They're quietly accumulating physical metal while the paper market still functions. When COMEX registered silver hits zero, when industrial users can't source metal, when the 4-to-1 paper ratio becomes infinite, silver won't rise smoothly. It will gap $50, $75, $100. These aren't price targets. These are mathematical outcomes when paper promises meet physical reality. The window to convert paper to physical is closing fast. Premiums are rising. Delivery times extending. Some dealers report inventory shortages. When the COMEX breaks, when contracts get cash settled, when premiums explode to $30 or $50 over non-existent spot prices, you'll be standing there with worthless paper, watching physical holders collect generational wealth. Let me put this in perspective. COMEX currently holds 440 million ounces total silver inventory. Sounds comfortable, right? Wrong. Only 124 million is registered, available for delivery. The other 316 million ounces is eligible, meaning it meets standards, but owners haven't approved delivery. It's like having 440 parking spaces, but only 124 actually available. The rest are reserved. Now consider this. If just 10% of silver ETF holders demanded physical delivery instead of paper shares, that's 44 million ounces. Add 10% of futures traders wanting actual metal, another 50 million ounces. We haven't even included industrial users desperate for supply. The math breaks instantly. Former COMEX traders confirm what insiders know. When registered silver drops below 50 million ounces, panic spreads through trading floors. Phone calls get frantic. Premiums spike. Delivery delays extend from days to weeks. We're currently at 124 million and falling fast. At December's drain rate, 47.6 million ounces in 4 days, we hit critical levels by March. But here's the twist that makes this crisis unprecedented. In 1980, the Hunt brothers were lone wolves fighting the establishment. Today, the establishment is accumulating too. Central banks bought 800 tons of gold in 2025. Why not silver? China restricted exports not to manipulate prices, but to secure supply for domestic industry. When governments hoard metals, it's not speculation, it's strategy. The signs are everywhere. Silver mining companies can't expand production fast enough. Recycling contributes only 150 to 180 million ounces annually, stagnant for years. Industrial demand surges 25% yearly, while mine output declines 7% since 2016. The deficit compounds daily and accelerates. Physical premiums tell the real story. Retail silver coins trade $8 to $12 above spot price. Industrial buyers pay $15 to $20 premiums for guaranteed supply. When paper trades at $30 but physical costs $50, the paper price is lying completely. It's measuring promises, not actual metal available for delivery today. COMEX's nuclear option remains: cash settlement, forced delivery failures, pay dollars instead of silver, change rules like 1980. But today's demand is global, structural, unstoppable. You can't cash settle solar panel production. You can't pay dollars instead of silver to electric vehicle manufacturers. Industrial demand doesn't care about exchange rules or paper promises at all. China's export restrictions created 3 isolated silver markets: Asia, North America, Europe, each region fighting over shrinking supplies desperately. Transocean arbitrage stopped working when shipping costs exceeded $10 per ounce. The global silver market fragmented completely. Scarcity became regional, then local, then absolute. 47.6 million ounces vanished in 4 trading days. 124 million registered silver remaining in COMEX vaults. 500 million promised in March alone. The math doesn't lie anymore. The Hunt brothers tried to break COMEX with 200 million ounces when the exchange held 200 million. They almost succeeded. Today, the entire world wants 700 million ounces annually from vaults, holding 124 million registered. The system isn't just stressed, it's mathematically doomed forever. The greatest wealth transfer in commodity history is loading now. When stage 4 hits, you'll either own actual physical silver or wish you had listened to these warning numbers.